What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 9th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to do a really big macro video when it comes to Bitcoin. It's one thing to do price analysis, guessing where we think Bitcoin is going to go off of what price is telling us. But I want to spend some time today to talk about why what helped Bitcoin over the last decade cannot come back into the picture. Today we're going to be talking about the Federal Reserve monetary policy, inflation, as well as the broader sentiment for investing in more speculative assets like crypto. We're going to be diving into a lot of things, guys. If you enjoyed this video, drop a like. It's one of the greatest ways you can support the channel. Let's go ahead and kick off the rambling. So this is going to be a really juicy episode here, guys. We're going to be diving through a lot of charts. But I, again, just want to emphasize real quick again on the recent Bitcoin price action. I know some people have gotten a little bit jittery here as Bitcoin has moved up about $700 since the start of the new year. Lots of small incremental green days, around a 1% move each day or so, right? Again, generally speaking though, or even a fraction of a percentage to be completely candid. Even though this is definitely nice to see some green price action, we're not seeing a major decline lower. We need not look any further in the market order flow, which has been one of our most consistent indicators week by week by week as to whether or not this is a time to FOMO. First off, I'd love to see in price action higher lows, higher highs, multiple pairs of higher lows and higher highs, and getting above some of these daily moving averages. I'll happily pay the premium. But on top of that as well, when we take a look at our partner tool Bookmap, take a look at that market order flow, even though price has been incrementally moving higher here, you can still have a negative cumulative volume delta or market outflow. And this is again why I keep telling you guys, if there's any other tools you guys use out there, I definitely recommend our free data science tool partner, CryptoQuant, where you guys get the dashboard with all my favorite data science models. But I definitely recommend you guys check out the multi-book feature from Bookmap. It allows you to see the deep liquidity of who's taking the best available offer. Are buyers taking the best available price or sellers? And sellers have continuously been outflowing their positions right now. And we got to see whether or not bids on the order book can really pick up that demand to sell. Now, we've talked about that there just quickly. Again, nothing's really changed. Just wanted to share my sentiment on that. But let's go ahead and dive into the real juicy stuff here. Now, I know a lot of you out there are like myself, and you watch all kinds of different charts. And for those of you who might not be watching, and I want to share this really interesting piece of information that I know some of you out there might have already figured out. And that is what's going on with a lot of the energy-based commodities like natural gas and oil, especially natural gas is looking quite interesting. Natural gas has gone from around $9 to $10 per CFD or contract for difference. It's a form of derivatives that allows you to trade or speculate on the price of natural gas, just kind of a way of measuring it through a financial instrument, all the way down to 3.73. It is now gone below for the first time since all the way back here in January 2019, below the 200-week moving average. All right. Now again, to I guess put it another way, the last time we were here below this range, I guess if you want to not just focus on crosses below it, was down here in April of 2021. And you don't need me to tell you this. If you just simply look at the chart and the fallout here, this turned from what could have been a spring up setup to the upside into a very clear decline. And week by week, we have been moving below those weekly moving averages, signaling that the Federal Reserve is likely starting to curb some of the demand that was driving up natural gas prices. There are now some of the supply chain, or more specifically in this case, production issues getting resolved. People taking advantage of the higher price of natural gas and a lot more producers coming to the market, you name it. So this has driven down natural gas prices. It's got a lot of people wondering whether or not the Federal Reserve can start to ease up. Can it start to not only increase interest rates at a lower pace, but on top of that, will it finally reach its max rate, and on top of that, potentially even start cutting? This is what's gotten a lot of people excited, or at least specifically the bulls, that the Federal Reserve has done their job and they can return back to normal. That's what everyone, whether they say it or not, that's what they believe. They want the Fed to come back towards stimulating with quantitative ease, and they want to see asset prices go up. And to be honest, as all of us to some degree think in our own kind of selfish interest, right? I'm not trying to say anyone's selfish. I'm just trying to use it as a term like we obviously want the markets to go up. There's nothing wrong with wanting that desire, but the thing we need to ask is whether or not it's realistic. because we do have to look broader here. While natural gas here, which has again been kind of showcasing that it might be at a temporary top here, or maybe the top for this market as it's been going into this 200-week pocket, we need to look a little bit broader into oil. And we need to ask a broader question here about why commodity prices are declining and whether or not this is, again, still a bullish sign just yet for equities, because we need to retrain our mindset on what has led equities to go up over the last decade and whether or not that factor can still be in play. So let's go ahead, again, just take a look here at oil, right? Oil is definitely looking weak here, meaning that the bulls might have an argument when it comes to equities if we're thinking in the traditional mindset, right? Again, we see the commodities, as we've talked about for months here. We wrote about in the Dash report here, I think back in September and October, to watch how we would see oil's price bounce between these moving averages. The number one key goal here, step number one towards getting towards a bullish future, I 100% agree, is getting commodity prices down. We are going to have to do this, because if we don't, inflation will come roaring back. And this is a sign, again, credit where it's due, that both a mixture of oil suppliers are increasing output, but on top of that as well, the Fed has been able, through hiked interest rates and therefore forcing other central banks to follow suit unless they want their currencies to grow too weak, that they too have to increase interest rates and slow down economic demand. So we're seeing that play in, that impact here. But again, even if here we don't hold at the 200-week, if the Fed is doing enough here and we go down below these 200-week moving averages, I want to go ahead and talk about whether or not it is a sign to get bullish. And I want to be very clear with you guys. Again, I'm not here to be a perma bear. We've spent the last decade, I was trading long on the vast majority of my trades. I was betting on price going up and to the right. I'm a pragmatic optimist, if you will. I do believe that things go up over time, but I'm not going to FOMO into things. I'm not going to try to pick bottoms. I need to see the signs that my investments are going to be safe and I'm on the winning side of the trade. Plain and simple. That's how any smart investor is going to think, whether it be to the upside or downside. Again, I'll be honest with you all, I think we're still living in a little bit of a delusional vision, if you will, if we think that the Federal Reserve can go back to normal, go back to the status quo of the last decade. And here's why. Because beyond what markets are starting to price things at, right? Markets can misprice things. They can interpret, certain types of events playing out. And again, are just trading off of information we have to work with. I want to go ahead and talk about a couple key things here. First off, we need to take a look at the CME Group Fed Market Watch tool. Now, this is a tool that's publicly available that actually showcases how the market is predicting what the Federal Reserve is going to do next when it comes to interest rates. And we can see that as soon as the next meeting in February, which is about 23 days away, right, we can see that the vast majority of the market, from the current target rate of 4.25% to 4.5%, they're estimating that we're going to go to 4.5% to 4.75%. So essentially a 25 basis point hike versus the previous 50% and therefore the previous 75%. People are starting to believe that the Federal Reserve can start to take a softer approach. And I'm not here to say that that can't be the case. Maybe they start switching to 25 basis point increases. It's clear that the Federal Reserve is in the driving seat right now, and they may be able to do slower hikes. But the key thing I want to emphasize is that the market is predicting that the Fed's dot plot that it has is inaccurate, it's overly hawkish, and that the Federal Reserve is not going to actually take rates that high and suspend them that high for as long as they plan. The market doesn't realize, if it doesn't turn back to the 70s, the Fed knows something this time around. They know that if they do not cool inflation, all those charts we just looked at, natural gas, oil, they will come raging back. Not to mention, we need to talk about the job openings here. The labor market, albeit it has been declining a little bit since December, is still red hot. The amount of jobs on the open market right now are almost still double what they were pre-pandemic, about 6 million to 10.5 million jobs. The labor market is red hot. The Fed knows unless they slow down the amount of job openings, lower the amount of economic opportunities, and therefore increases in opportunities for wage increases, they are not going to be able to tame inflation. That's more excess money that companies are injecting the economy, where consumers are spending, you name it. I'm not saying I'm against wage increases in the long term. I definitely would love to see that, but it needs to happen in an environment where there's not other inflationary pressures, where there's not so much excess money. And we need not look any further. Taking a look here on the Zillow metrics for the cost of general homes across the world, you can take a look at single family homes, condos, or cooperatives here. You can see that we've been hanging sideways here. We're not seeing a steady decline in property value prices. And why is this? Why does this all lead back to why the Federal Reserve can't take the easy route, and more specifically, why it cannot re-engage in quantitative easing for a very, very long time? It's because we already have too much money in the system. And there are plenty of data points we can look at that prove this point. There's so many points that prove why there will not likely be QE for a long period of time, and this is something we need to face as a reality when it comes to asset prices. We have had interest rates increase at their fastest rate in decades, blowing past the previous highs in 2019 and getting very close. We will be here in the next two FOMC meetings up to territory we saw back in the 90s and early 2000s, as well as potentially coming up to where we were back in the 1980s to some degree, not as high as the Paul Volcker era. I wouldn't want to make that argument. But generally, we've had excessively hiked interest rates, yet at the same time, property values untouched, labor markets still strong. This showcases that there's a lot of corporate cash out there that's still being invested actively in the economy. And that is going to suspend wages. It's going to suspend consumer confidence here. Plus, we've just generally got a lot of money in the system, right? Think about the world before the pandemic. We were around $4 trillion in base money supply out there in the world. We are still sitting at more than twice that number. And I'm not saying we need to, again, close down all of those, those increases in the base money supply since the pandemic. That is one of the predictable routes that the Fed could take. But I think, again, we are going to be much more somewhere in the middle, which is between reducing the secondary excess wave of liquidity post the pandemic that started mainly in 2021, or cutting about half of the balance sheet. I think these are reasonable targets. And as you can see, as we mapped out here that have been continued to play out, here's the Fed has been tightening, we can see that this is going to take time. The Fed, just this past month alone, absorbed $138 billion of liquidity from the system. $138 billion in the month of November. What's it going to look like in the month of December? Right? Because this is working, if we turn off our drawings, you can see this is an accelerating pace from $23.5 billion in July to $63 billion, to $30 billion to $72 billion, to $138 billion. You can start to see that momentum, generally speaking, is ticking up. And this is not going to benefit asset prices for a very long time. Not to mention, again, if we know that the Fed is tightening here or needs to keep things lower in order to combat inflation and continue to keep inflation well below 2% for a prolonged period of time, which we're still not there yet, this is, again, a sign we need to be cautious about making any major bets on equities, making substantial returns, maintaining uptrends, etc. Again, I would just say really like the data here, guys, on property values. If the Fed sees that property values are still pushing sideways, they know there's still too much money in the system. Not to mention when mortgage rates are at their highest level in 15 to 20 years, surging absolutely vertical. They know that people aren't opening and taking out mortgages because people just have the money. They have the cash to go out and buy these properties. There were people who made too much silly money over the past decade that needs to be absorbed out of the system so it cannot cause commodity-based inflation. Case in point. All right, this is the key thing the Fed understands here this time around. And what makes this inflationary cycle very different and also difficult as well to predict. Now, the big thing I want to emphasize here as well is that when we're taking a look at Bitcoin here, guys, unless the NASDAQ and technology stocks in general start to really show up to the plate and start setting in higher lows and higher highs, I really wouldn't be making too many big moves on crypto right now. I'd remain patient. I remain in cash. Right now, we've continued to make significant lower highs. We're not even coming up to test that 200 day. We are facing resistance at the 200 week. And while I understand it's difficult, when you guys are actively watching the markets and stuff, I've been through this, traded for over 11 years. I understand it's difficult to sit on the sidelines, especially when you see these upticks, 4 or 5% moves and thinking, oh my gosh, am I going to miss this? The key thing here is to wait for the signs. Pay a little bit of a premium if you have to in order to be able to sit on the sidelines and not stress about it. You'll still be able to catch the cycle when it comes here. We will be bullish when the time is right. But we're not trying to pick bottoms here and play our odds. We need to turn to the data. We need to be disciplined. We need to understand that the expectations that the market still has are built off of a system that could only exist over the last decade when there were incredibly low levels of inflation. And we need to realize that the inflation we're dealing with is not just some supply chain issue or just some phenomena that just came out of nowhere. It's a monetary phenomena, and we are facing the consequences of what happened over the last decade, especially with the blow-off top that we had during the pandemic and the excess amount of money we printed while also shutting down the entire global economy. It was not a good choice, and we are unfortunately going to have to face the ramifications of this. But for those of you who have been in cash, who can be patient, there will be a lot of opportunities, not just in equities, but also in crypto. While we saw a nice 10% bump up here in altcoins, if we take a look back at the relief rally here back in July and August, we have multiple weeks of upper single-digit moves, a much more stronger bump up here. So this is, again, a sign that I think we are going to be moving lower before we really find our bottom in altcoins. We wrote about it in this month during the Dash report. It's one of our biggest focus points because I understand a lot of you out there want to be able to make those really solid generational returns. Find the plays that are going to make some serious returns in the next bull market. And that's why not only do we focus on it in the Dash report this month, but I also want to spend some time to talk about one of the few projects that's got me really excited, and that is Crixivia. Now, if you guys haven't heard about Crixivia just yet, this is one of the few gaming projects in the crypto space that I actually like, that I've actually invested in. Didn't do any pre-sale investment, bought a spot on the market with my own capital. And the thing about Crixivia is that it's one of the more exciting games out there because they've continuously delivered and are actually building a world that you want to spend time in, that you actually get excited about, and actually is continuing to develop and foster a community. Now, if you guys haven't seen gameplay for Crixivia, I definitely recommend you guys watch the trailer, check out the channel, some of the content you can find on YouTube. But Crixivia is planning on January 13th to launch its long-awaited beta after already releasing its alpha back a couple months to a year ago. Now, if you guys want to check out some of the developments, I recommend you follow them on Twitter. Their Twitter handle here is Crixivia on Twitter. It's quite simple to find. But generally from there, you can find a lot of great updates. Even since we last talked about them on Friday, you can see that they're launching their herbalism feature where you can actually craft potions for your characters when you're fighting bosses. On top of that as well, they have multiple new worlds that are going to be coming out, as well as NFT-based armor pieces within the game so you can customize your character and continue to progress. If any of you have played World of Warcraft or RuneScape, like I have, I'm more on the RuneScape camp, you know just how incredible this game can be, especially if you spend some time playing it. So what I want to ask you guys to do, check out the link down below in the description, check out Crixivia's website, follow them on Twitter, just give the game a spin. And the thing is that you don't even, again, have to invest in this case within the game. The major thing is that you can actually earn as you play the game. So I think a lot of the early adopters of titles like Crixivia are going to benefit greatly here in the next cycle. Again, even if you just want to play the game. So again, I recommend you guys check it out. But these are, again, the kind of projects that I'm drawn towards. Those who are building during a bear market. And as we continue to go throughout the bear market, it's going to flush out a lot of players who just simply aren't serious, don't have the capital to survive, or don't have the actual value proposition to survive a bear market and foster in a new bull market. So anyways, that's it for my rambling today, guys. I hope you all enjoyed this video. If you liked it, consider dropping a like. It's one of the best ways you guys can support the channel. Always helps me out in doing this full time. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.